Hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's Wednesday, January 15th, and we're live streaming here from a kind of overcast and foggy Redmond, Washington. I appreciate you joining me every weekday after the close as we live stream on LinkedIn, Facebook, YouTube, and X. I appreciate those of you that are tuning in live. You do have the ability to ask questions. Any questions you put in on any of those platforms, I can see them through the streaming platform I'm using. So look forward to those. At the end of the show, I hope to take a question or two before we wrap the live stream. If you're watching the replay on our YouTube channel, I appreciate you as well. And drop a comment below the video with any questions for our mailbag. Any of the questions we don't get to during the normal day-to-day activity of the show, we'll put it in the mailbag and hope to get to your question on Friday of this week when it's our next planned mailbag episode. Nice up day. We haven't had one of these in a little while, so it might feel a little uncomfortable in a very good way to see a lot of green on your monitor. You're going to assume we look at the market carpet, heat map style visualization, a lot of green. Not everywhere. There's some stocks that were not particularly strong today, but generally speaking, big up day. You had the 1-2 punch of inflation data between the PPI and CPI. Sort of giving a positive boost. Also, earnings season kicking off and some big banks doing some pretty good things earnings-wise. And that is both of those causing the markets to rip back to the upside very quickly. Let's look at what happened, what this means relative to all the other discussions we've been talking about with signs of distribution and breadth divergences, et cetera, et cetera. What now? Let's get to the charts. And first, we'll get to the market recap and see how things played out, particularly today. So the S&P 500, again, a strong up day, up 1.8%. We closed just below 59.50. Now that obviously is well above our line in the sand, which was 58.50. So certainly a nice upswing day. The Nasdaq Composite outperforming, up about 2.5% today. Mid caps and small caps all in the green. And the S&P 400 mid cap index, the worst performer, still up 1.3%. The VIX moving about 2.5 VIX points lower. Now, the VIX never really gave a big disastrous sell signal or anything here in January. Sort of remained below 20, which is kind of our basic level to watch. Anything below there is low volatility. Not much to see here, not much to be concerned about. So today's rally, VIX dropping, volatility coming back down to really the mid-teens. So, volatility remains fairly low compared to historical levels and suggests we're still in decent shape. Volatility-wise, or I guess fear-wise, looking at the bond markets, bonds rallied with stocks today. The TLT was up about 1.7%. That means rates are coming down. The 10-year yield finishing the day quite a bit lower, around 4.65. The long bond yield below 4.9%, around 4.88. We were testing that 5% level on the long bond. Now coming off of there. Still, of course, a normal shape to the yield curve now. We talked about the implications of that, why that could be a very good thing for financials. And, one of the things we talked about looking forward to this week was kicking off earnings season on Wednesday today with the big banks reporting earnings. A lot of regional banks and other financial institutions reporting tomorrow and Friday. Great start, and again, I haven't taken the time to go through some of those earnings releases just yet. However, be interesting to hear what is discussed in terms of the interest rate environment, the normal shaped yield curve, what that might mean. So overall, it means banks are doing just fine. Dollar index, honestly, no real change from yesterday. We talked about the strength in the U.S. dollar as a warning sign. Not much of a follow through today, but not really much of a drop in the dollar index. It's kind of staying steady to where it was yesterday. Looking at the commodity space, commodities generally moved higher today. The DBC, which is a broad commodity ETF, finished up 1.6%. Gold price is still higher, about 0.8%. Silver even better, up 2.8%. I love days like today that just are a great subtle reminder to not think of gold as a safe haven, although it has gotten that moniker for good reason, because at times when stocks have been struggling, gold has actually held up quite well as a store of value, but that correlation is not as strongly inverse as you probably think it is. Sort of the conventional wisdom says gold is a safe haven, means when stocks are rallying, gold's probably going lower because you don't need a safe haven, but gold doesn't care what we think. It's going higher today, silver as well. Broad commodities all going higher, crude oil pushing to the upside as well. And if things like banks and consumer names were not as strong, energy would have been at the top of the leaderboard with oil prices going up like that, but ended up being in the middle of the pack here. In terms of Bitcoin, this risk on move, and that's a big way, I think a very fair way of describing today's price action, a nice risk on bounce off of a swing low. Did briefly push Bitcoin above 100,000. We talked about the inability of Bitcoin to regain that key foothold, and if so, hold above there, and that's what we've been unable to do here in the last 6 months. And for now, just below there, currently trading around 99,630. That's just slightly below 100,000. It did briefly get above there here in the last couple hours, last 6 hours or so. So Bitcoin right below 100,000. That is. Ether prices currently just around 34, and that's still below that 4,000 level. That's sort of the key level of resistance that we are testing with Bitcoin. But all the top 10 coins tracked on the stock charts platform, all in the green. Again, cryptocurrency is very much, I would argue, almost like a leveraged equity ETF in a lot of ways in terms of increased volatility, way more volatile than normal stocks, but essentially tend to follow the risk on and risk off movements of the equity space. So, completing, I would say today, sort of following through on what I think has become a fair expectation about how cryptocurrencies tend to trade relative to stocks. Here, looking at the 11 S&P sectors, financials and consumer discretionary almost perfectly tied for first place today, both up just over 2.5%. Financials getting the top of the leaderboard, and again, earnings really kicked off. We'll look at a couple of those charts. I'd encourage you to go deeper into some of those names because there's a lot of strength. And we talked about the financial sector and some of those things we would need to see today, really sort of giving a nice upside boost from a technical perspective for sure. Consumer discretionary number 2, keep an eye on some of those larger names. The XLY is dominated by 3 stocks: Amazon, Tesla, Home Depot. You'll note that some of those had pretty good updates. Tesla in particular, one of the biggest gainers in the S&P today. Technology up 2% and a nice upside move for technology, the XLK. On the downside, only one of the 11 S&P sectors in the red. That's consumer staples, ticker XLP, down about 1/3%. Healthcare, real estate, both up slightly, about 0.4%. Those are second and third from the bottom of the list. Check out the breadth today. We've talked, and I've talked with so many of my recent guests on the Market Misbehavior podcast. By the way, latest episode with Adam Turnquist was just released maybe an hour or two ago, and that was a really good discussion with Adam. Adam's the chief technical analyst at LPL Financial. So he works with the financial advisors in the LPL network, and really thoughtful analyst, and had some really good points about breadth, but focused a lot more on the history lesson that technical analysis provides, some interesting views on what 2025 may be most closely related to, not 2021 to 2022, but he had a previous period, 2 periods actually, that he compared them to. I'd encourage you to check out that episode posted on our YouTube channel. Today, for example, though, while the breadth overall has been weaker, and we've documented that very closely over the last 4 to 6 weeks, as breadth indicators went from incredibly high, really at the end of September, to kind of high in November and December, and then quite low as we got into the new year. I think mid-December to mid-January, quite a change. Today and yesterday, you're seeing a lot more advancers than decliners. Today, about a 7-to-3 ratio. Is that the way that we do that math? No, it's about a 3-to-1 ratio of S&P stocks moving higher versus lower. It's about 74% to the upside, 27% to the downside. So most stocks were up today. It wasn't just the Magnificent Seven working. It was kind of a little of everything. So obviously for today, a big risk on day. Now, the point of this show and the point of what we always talk about when we're looking at charts is not just to focus on one day's action, although that's what we're recapping. It's thinking about what happened today relative to the larger themes that we've observed. And that's what we'll spend most of the time for the remainder of the show trying to dig into. Before we get there, though, do want to note that Tesla up 8% today. That's your biggest gainer out of the Magnificent Seven names. I mean, Tesla's still sort of in a sideways choppy mode. And I would say that's an initial assessment looking at some of these mega cap growth names. While, again, big up day with Meta up almost 4%, NVIDIA up over 3%. These are stocks have been pulling back off of previous all-time highs. So still more to prove, I would say, from a medium-term perspective in terms of resuming a larger uptrend. But certainly a day like today seems to help. I did grab the chart of Tesla and one others, maybe Amazon, if I remember correctly, looking forward to the chart review portion of the day. All right, that's what happened today. Obviously, a big risk on move when the inflation data came out before the open, and then getting into earnings certainly seemed to be just a lot of upside catalysts here. I also want to mention really quickly, we'll look at some of the expectations before we get to the heat map. I did want to point out it's actually fluctuated quite a bit as I'm looking at this. Earlier in the day, I feel like there was a bit more of a spike of people pricing in a potential rate cut at the January meeting. I might have made that up. It looks like still about I might have been looking at a couple other numbers for the meeting coming up in a couple weeks, 2 weeks from today. Basically 97% chance that we leave rates the same, or the Fed, and a slight, basically just above zero that they would lower 25 basis point. It had been kind of a similar number for the March meeting, but now all of a sudden you're seeing a 28% probability of a rate cut at the March 19th meeting, and a 71% chance we remain the same. So interesting to see how the market is now starting to price in maybe additional expectations or higher possibility of a rate cut coming as early as the March meeting. Still, the base case is no change over the next couple meetings, maybe out until May or June. But we'll see how things fluctuate. Again, it's sort of a dynamic part of the markets as we get a bunch of inflation data this week. Building on what we talked about in terms of earnings expectations, I just want to show the market carpet, which is a heat map style visualization. This is a brilliant way of just sort of illustrating the overall market activity today using the S&P 500 members. I mean, my initial takeaway is big up day. And I think the biggest, the strongest argument for strength for the broader market is the fact that the biggest boxes are showing the biggest green. That's one of the things we always talk about. The big dogs, the Magnificent Seven names, what are they doing? They're up a lot today. So the average Magnificent Seven stock having a decent day today, that certainly is driving the markets higher. I talked with Adam Turnquist on the podcast about the equal weighted S&P. And what's funny is if you kind of cover up the left half of the heat map and just look at the right half, not a great day all of a sudden, right? I mean, you can see that the green is concentrated in some of the larger names in these growth sectors like communication services, like technology, like consumer discretionary. But even in the XLY, if you cover up the big three, Amazon, Tesla, Home Depot, all which were up quite a bit today, the rest of the sector not particularly strong. As a matter of fact, kind of neutral at best, I would say, right? It's sort of a little up, a little down. The financial sector kind of different. I mean, this is where most names had a pretty good day today. And again, earnings are a big part of that. Companies either reported earnings and reported some blowout numbers, or a lot of other banks are going up in sympathy, a sympathy vote for some of the strong earnings elsewhere, assuming that they will have similar great numbers to report here in the coming days and weeks. Further off to the right, which is where we get into some of the other value sectors, healthcare. Not a great day, actually. A lot of down moves today on a big update. Consumer staples, incredibly weak. Very few stocks even in the green. Most stocks actually neutral to negative. And elsewhere, particularly in the defensive sectors, you're seeing quite a few stocks actually rotating to the downside. So the theme we've been talking about through the course of early days of 2025 here in January has been outperformance of growth as a potential emerging theme. Potential outperformance of small caps, given some of the headwinds to mega cap stocks that we've talked about. Maybe looking for strength in defensive sectors, although we've certainly not seen anything like that. Today, a contrarian move to all of those themes that I just mentioned. Right, for today, you get kind of the growth over value trade. You get the FANG stocks leading the way higher. The question after a day like this is it sustainable, right? What's the difference between a one-day bounce off of a beaten down level on good numbers versus more of a sustainable reversal in trend? This is why technical analysis is not based on one day's action. It's based on the trend over time and looking how that evidence has evolved or it changes over time. So with that in mind, let's get to the chart review and focus on some of the individual charts. So here's what today's move higher means for the chart of the S&P, and I have a couple thoughts to share with you. Number one, this definitely brings us back above the trend line, neckline support, right? So we had 58.50 as a line in the sand. We broke that on Friday on a closing basis. The last 2 days, although we did, have slightly higher closes, we kept closing below the 58.50 level. Comments we made earlier this week, a move back above 58.50 certainly would bring that into question. Question now raised, right? A note that the S&P traded right up to its 50-day moving average, stalled there for now, but overall, again, a nice gap higher. This is a trend line that we've drawn on the previous swing highs. Whenever you have a head and shoulders top that is confirmed, if you're assuming that the trend is going to go down, you always want to think about, well, what would tell me I'm wrong? What would tell me the trend is no longer down, right? And I would say with any sort of view you have on any chart, you always want to think about what the chart would do to tell me that whatever that thesis was is no longer effective. I would say breaking above trendline resistance would be it for me. And on a head and shoulders top, you always have that head and then the right shoulder, which is lower. So drawing a trend line between those 2 points can be a really good sort of exit strategy. So, at this point, we're kind of trading up back into this pattern, breaking above that trend line resistance as early as tomorrow. I think the market's going back to 6,100 and maybe going further. That's what an upside reversal could mean. However, of course, if we stall out here, then again, we pay attention to 58.50, look for the break below, which still I think is a valid level of support. Now it just appears to be re-engaged. Worth noting that the RSI, the momentum is dead even now. And what that means is over the last month, while we've been talking about this broader rotation lower, the momentum is actually pretty evenly balanced between up days and down days. So, during an uptrend or a downtrend, you will have individual days that are up and down. The RSI is based on the ratio of the average up day to the average down day, then a bunch of other math, which takes too long to go through it. But I would say the fact that the RSI is almost dead neutral really speaks to this market at an equilibrium phase. One change I will make to this chart as we're talking, one of the things I like to do anytime you have a gap, and you'll see it on earlier lines on the chart, although I do keep this chart updated and try to clean it up as much as possible. It's hard sometimes in the day-to-day movements. Anytime there's a gap like this, I like to kind of take the gap and set that up as a think of it as kind of support and resistance range, right? Sort of an area. I don't think of gap as anything more complicated than this is now a support zone, a support level. So again, now this 58.70 to 5,900 is the gap between yesterday's high and today's low, which was essentially right at the open. So keep an eye on that gap level here through the remainder of this week. Do we hold that gap or not? So today's gap higher, of course, the bounce higher with the S&P pushing back above our neckline support does bring the bearish view that we've been talking about certainly into question. At this point, it's how much of a move higher negates that downtrend. For me, pushing above trendline resistance again could be as early as tomorrow would tell me to rethink and reposition potentially. I will point out on the Nasdaq 100 and then also on the small cap index what today's move means. Excuse me. With the Nasdaq 100, the QQQ, I've been sort of labeling this as a bull flag-ish pattern, right? A bull flag is when you have a run higher, you have lower highs and lower lows. So we've bounced off of the lower end of that support. I actually drew this back here when I sort of saw this rotation. So it's interesting that we're now continuing to follow this flag. Now that bull flag pattern becomes a big buy signal if and when you exit the pattern to the upside, which would mean the Qs closing above 520 tomorrow would sort of complete that pattern, complete that bull flag and suggest further upside. This is after the most recent push down to the QQQ level around 500. The RSI has held 40 there. So overall, still pretty good. And it's interesting, a day like today just reminds you why you think about the short-term movements, but also the medium-term and the long-term trend. Medium-term trend has still been bullish, I think, based on my market trend model and sort of the main ways that I measure it. The question is today's bounce a one-day thing, or does it turn into something further? Let's keep an eye on charts like this to see if they're able to break above resistance. Now, the small cap index, if you draw similar lines to what we've seen on those previous two charts, which is taking the peak and then taking subsequent highs and sort of lining those up, you noted that the IWM actually gapped above that trend line resistance today, but at the close, actually right back to it. So as much as this felt like it might be a nice breakout above trendline resistance and make me think about the previous swing high, not there yet. So on any time frame, another thing I would say is watch the highs and the lows. Even with today's gap on the IWM, we're still making a lower high coming off of a lower low. I get bullish when those things change and when we start making higher highs and higher lows again. What that means is we pull back. Do we hold the 200-day moving average a little bit above that that high from earlier this week? That would be the main question on something like the on the Russell 2000. Now, the breadth conditions, while they certainly were strong today for one day only, when you think about the overall measure of trend of breadth, not much of a change. I mean, in terms of stocks above their 50-day, quite a few now are regaining their 50-day moving average this week. As a matter of fact, it was just below 20% at the end of last week. Now we're just above 30%. So we're seeing about, 10, 12% of the S&P members breaking back above their 50-day moving average as the S&P tests its very own 50-day moving average right around 59.50. The bull case for stocks from here, as we've mentioned, means would have to include, I would argue, a dramatic improvement in breadth indicators that have gone very low. Now, some of these are starting to bounce higher. They'd really have to push higher. And I would say this one gets above 50%. That would be a nice bullish sign suggesting short-term strength and enough short-term strength that the benchmarks have a chance of having more of a recovery. The long-term breadth measures we've been looking at have never gone bearish, right? And I think that's important to note as well. We've been thinking of this as a pullback within a longer-term uptrend. I don't see any reason to change that view just yet. And I think indicators like this breaking below 50% would force me to rethink and think more of a protracted decline, holding this week, which may be an interesting data point to remember. Now, bond prices popped higher. We have the chart of the TLT, I believe, in a minute. Yep. But right now we have the dollar sign TNX. This is the 10-year Treasury yield. I drew a trend line below here. Anytime you have this sort of market, a chart in a clear trend of higher highs and higher lows. I don't know if trend lines are the most perfect trading vehicle I've ever used. I probably wouldn't manage money based purely on trend line analysis, but as a visual representation of the pace of the move and an idea of when that trend may be reversed, I think trend lines can be very valuable, which means while this larger trend of higher rates has been in place since mid-September, there's quite a bit of a pullback in rates that could occur and still be within the general structure of this trend has been in place since September, which means 10-year can get all the way down around 4.4% and still technically been in a pretty clear uptrend phase according to the longer term time frame. Now we are seeing a bit of a counter trend bounce in bond prices, which is causing yields to come down. This is what the chart of the TLT looks like, and again, a gap higher today. So again, I'll probably put later when I have a moment, put one of those gap rectangles, I guess you'd call it, as gap range, sort of highlighting that gap and just reflecting on the importance of that level. At the bottom of this chart, I have the PPO indicator. While the gap higher in bond prices, certainly a strong move today in line with the rally in stocks, the PPO indicator actually not quite giving a buy signal. When you have something that's been going down a ways and the PPO indicator gets below zero, waiting for that buy signal can often be a really good, sort of confirmation that a low, at least a tradable low, is probably in. We saw that back here right around Halloween, and bonds did get slightly lower, but the indicator actually gave a buy signal the first week in November, suggesting an eventual upswing. Before that, you have to go back here to late April of last year for the last time you had that buy signal after a downtrend. So we've been in a downtrend phase. The PPO indicator well below zero, not quite getting a buy signal today. But that's something I would be looking for through the remainder of this week. And if you do get that buy signal on the TLT, what that implies, at least in the short term, higher bond prices, lower rates, and one of those big, trends that we've observed since mid-September, at least a pause in that uptrend as rates start to pull back a little bit. So you can see a number of charts I think that are pretty key to watch for and some levels to pay attention to, which could help us to evaluate how we get out of this sort of choppy period that we're in here. Cryptocurrencies, as I mentioned in the market recap, all rallying pretty good today. The top 10 coins were all in the green. Bitcoin pushing back toward that 100,000 level. In the last couple of weeks, most recently, Bitcoin popped up to around 102.50, 102,050, we'll call that 102,500 is basically that level. We then pulled back and got just slightly below 90,000 just a couple of days ago. This is coming into this week on Monday. And now we started to rally back above those levels. That 100,000 level, just again, it continues to be the important level for me to watch. I think this is a bullish chart as long as it can get above 100,000 and stay there, and that's what it's been unable to do so far in the last couple months. Getting above there, putting in a higher low, that would be another thing that would be a really nice sign to confirm upside follow through potential for Bitcoin. But for now, we wait to see if it's able to complete that move above 100,000. It did trade slightly above that today, but not able to hold it just yet. All right, let's look at some individual names that I think tell the story of what happened in the markets today. Banks and most financial institutions probably having a pretty decent day today. I'm looking at Bank of New York Mellon. There's some large money center banks, also some regional banks reporting today, tomorrow, Friday, and then earnings season really accelerates over the next couple weeks, going into the first Fed meeting of the year at the end of January. BK is one of those financial stocks that had been in an incredibly consistent uptrend, spent most of 2024 above an upward sloping 50-day moving average, but that changed in mid-December when it closed below the 50-day. And over the last couple of weeks, we've seen a number of retests that have failed to get above the 50-day moving average. Today's gap higher completes that break back above the 50-day moving average. That's an encouraging follow-through sign and great way to kick off earnings here with charts like this doing this sort of move. Now, of course, you immediately have to look left on the chart and recognize the previous all-time high from November on an adjusted basis. That's right, just above 82.50. We're very close to hitting that today, up about 8%, but not quite there. I think charts like this, do we get the follow-through above previous resistance on improving momentum? Looks pretty good with the gap higher today, but let's see if we can clear that November peak. Other stocks in the group have already been in fairly constructive patterns, and Citigroup reported today great numbers, up 6.5% today. We're overbought again. That doesn't matter to me a whole lot. I mean, if you look at times when we've had pullbacks and then have accelerated higher, we become overbought in November of 2023. We remain overbought for about 7-8 weeks or so until the second week in January of 2024. So stocks becoming overbought often are the beginning of a nice big uptrend. What's happened from a technical perspective on Citigroup, you had this gap higher in early November, taking us above the July and October peaks. We then pulled back and essentially tested that breakout level as well as the ascending 50-day moving average. And over the last couple of weeks, we've just been holding above moving average support. So we mentioned on yesterday's show, I forget what the ticker was, but I always end the show by saying it's always a good time to own good charts. Charts above two upward sloping moving averages at a time when it feels like most stocks are below their moving averages. Those are good charts, right? I mean, if you just think of how to differentiate the good from the bad from the okay, in this sort of environment, stocks that have been able to hold upward sloping 50 and 200-day moving averages, those are good trends, and those are most likely, if not absolutely certainly, outperforming the S&P 500. Citigroup is all of that. So today's gap higher, just continuing the uptrend that we've seen. This makes yet another higher high after previous higher lows. This is a chart in a confirmed uptrend. JP Morgan, kind of the same thing. You can see we're making a new all-time closing high today, just above 252. We're not quite overbought at this particular point, but I'm noting how this is a chart in a pretty consistent uptrend. And again, this is the type of chart we're alluding to. We mentioned scanning for stocks above upward sloping moving averages. These are the types of charts. You kind of think of these as like a core holding, right? A core holding means something that it's just a nice, good trend. I'm going to want to own it until something dramatically different changes, and I see some change to the trend. But as long as we keep making higher highs and higher lows, that's a trend I'm going to want to follow. And I would say with Citigroup, with JP Morgan earnings today, just giving that catalyst for the next leg higher, making new highs. Now, I mentioned the Magnificent Seven stocks having a pretty decent day, outperforming the S&P, and that's really causing a nice upside in the Nasdaq 100 as well because of the weight in these larger names. I'll point out that Tesla, again, while it's pulled back from mid-December to early January, has held an upward sloping 50-day moving average. And so today's bounce about 8%. Tesla's one of those weird charts, by the way. It looks like a really normal kind of boring chart. But if you look at the price action, look at the y-axis and what sort of values you're dealing with here, what sort of percent changes. an 8% move is just this little day today. That's how volatile these assets have been. Tesla, in a lot of ways, is trading more like Bitcoin than anything. I mean, go figure. Given what's happened with Elon Musk and the administration, et cetera, et cetera. But I would say that obviously there's a ton of volatility embedded in the price of Tesla and the price action that we've seen. But a nice upside follow through, higher low around 375, 380, above the 50-day moving average today, kind of following through to the upside as well. Amazon, which has been pulling back from its all-time high in mid-December, again holding the 50-day this week. Today, pushing higher, up about 2.6%. The momentum really hasn't gotten that negative on Amazon. It's actually been pretty strong. So, as we've talked about some of the reasons why the market could and arguably should go lower, given all the deterioration that we've recognized, charts like Amazon just still looking pretty good are one of the things that have caused us not to just start yelling bear market. Even though, again, we've seen things like the Hindenburg moment and other things which certainly suggest we're there. Until an Amazon breaks down, how bearish do you want to be? And I think that's a great takeaway from this week is follow leading names and see where they pull back to. Now, it's not all great, right? I mean, there are charts that are going down. I would say one of the key ratios that has not gone down in quite some time is offense versus defense. If you look at the consumer discretionary versus consumer staples sectors, or just take some random stocks in those two sectors, it's pretty clear what's working and what's not. And what's not working is the consumer staples sector. This is ConAgra Brands, ticker CAG. This is a food products company. If you're looking for something to maybe be bullish about, I mean, you have to be thinking about, bottom fishing and looking for a stock that's so beaten down relative to where it's been and maybe retesting a 2023 low. That's not how I usually like to invest. I'd much rather patiently wait for something like CAG to improve, to show signs of accumulation, to show that buyers are coming in. But we're not seeing that yet. So today, one of the worst performers in the S&P. But again, I think the technical characteristics remind you that a stock making lower highs and lower lows, a stock that gapped lower and then just kind of kept going down and really wasn't able to regain the gap at all. That tells you, I think, all you need to know about the potential upside for the stock. I think a chart like this looks good when it starts to recover a descending 50-day moving average, when the momentum improves, the RSI gets above 60 on a rally. Those are the things that tell me maybe we're in a new uptrend phase. Not seeing any of those things on the chart of CAG and a lot of staples at the same time. I'll take a question or two here in a minute, but I did want to finish with Lululemon. While some charts I would argue look, very strong. Some of the big banks we mentioned are good examples of that. Some charts look clearly negative, as food products names like CAG would indicate. There are charts very much in a question mark phase. I think Lululemon is a really good example of that. From sort of a longer term perspective, I think there's a lot to like in terms of a stock that's bounced off of where it was in August of last year and got all the way up to 420 in early December, kind of retesting that earlier this month. While we have been making higher highs and higher lows, we've stalled out and we're no longer making higher highs, right? So while we are making a higher low, we're not really making new highs, right? So this is really a consolidation phase. This is you can kind of draw a box or a rectangle around this price action between the gap higher that we saw there, the swing lows in December, and the highs kind of in that 410 to 420 range. This is the kind of chart I would argue is very much in wait and see mode. One of two things is going to happen. Either we break below that December swing low, we break below the 50-day and really accelerate to the downside, or we finally rally up and retest that 420 level and push above it. But until we exit this range, I think this is one of those times when you wait. Jesse Livermore, as I love to quote, said there's time to go long, time to go short, time to go fishing. This is the kind of chart, if I had to rate stocks buy, sell, or neutral, this would be a neutral, right? At least wait and see which way we break. And the direction of that momentum could tell us a lot about what might come next. All right. Take a couple questions, and I appreciate those of you watching live on the platforms that I mentioned. Thanks so much for keeping it interactive. It's awesome to see the questions that come in. Really helps me to think about what sort of topics I want to cover and what areas to focus on. Titus Ryder, thanks for watching on YouTube. You mentioned, can you please show the chart that shows the probabilities of Fed rate cuts, rate hikes or cuts? For sure. And what's so funny, I mean, this is one of those great signs of the times. I feel like the longer you're in the financial industry, what was happening at the beginning of your career becomes more and more quaint and antiquated. I was telling students at Texas A&M recently about, stocks moving from trading on eighths and sixteenths to trading on decimals, and just the whole idea that stocks didn't trade on decimals was not a concept that I think many of them were familiar with. So we had to kind of talk about how things used to be back in the day. But again, I mean, that's what happens in the industry, right? So the reason why I mentioned that story now is we used to actually do this manually. You look at the Fed funds futures market, you take an Excel spreadsheet, and you can actually calculate the implied changes that the market is pricing in. And by looking at the Fed funds futures at different strike prices looking forward, you can kind of interpolate where the market is expecting, what sort of probabilities are expected for rate hikes or rate cuts at future meetings. And basically they have futures that expire around those different meetings, or you look at the dates of the meetings and use that to triangulate what sort of probability is being priced in. Now, of course, you don't need to do it manually on an Excel spreadsheet. You go to the CME Group's website, just Google CME Group Fed Watch tool, which is what they call this, and they do it all for you, and it's pretty awesome, actually. So here we're looking at the Fed meetings coming up. Here's the January 29th meeting. This is basically saying the current rate is 4.25 to 4.5. 97% probability, according to the futures markets, that there's no change. 2.7, I mean, the slightest of values that there's a lowering, a rate cut here. So highly likely that there's no change. But then you can go out to the March meeting and say there's a 28% chance of a rate cut there. By the May meeting, 42% chance that rates are 25% lower, and almost a 10% chance that they're 50 basis points below the current level here. And they go pricing all the way out to December. And what happens as you go further out is you'll see it's more of a bell curve, right? It's more of a normal curve, because as we go further out, there's less and less certainty about what's going to happen. There's more of a spread in expectations. As a result, the futures market is pretty unclear about what's going to happen in December, as we all are, because there's a lot of game to be had between now and then. But that is the way to use it. I actually have this up on another monitor off camera here, along with different ways of monitoring the markets, different news feeds and things, and then the Fed Watch tool, which I look at a couple times a week. And at the bottom, I didn't show you, but that shows you how those probabilities have changed over the last day, over the last week, over the last month. So you can see how the market's expectations are fluctuating. Pretty cool tool, and the fact that it's available for free from the CME is pretty awesome. All right, NZC will call you, and I appreciate you. I'm going to assume that you're referring to Seattle, and if not, I appreciate you watching no matter what. Hi, Dave. I'd be interested in your thoughts on GEVO. Now, I know a lot of tickers. That is not one that pops off the top of my head, so let's see what this is. Oh, yeah, specialty chemical company, so smaller name, right? This is more kind of in that, small mid-cap space, you probably call this, SMID cap, I guess. So not familiar with this name. It's not an S&P name. It's a smaller name that I'm less familiar with. Certainly a low-priced stock, right? You're trading below $5 a share, and immediately that tells you it limits the number of participants that can actually trade those stocks. A lot of larger investors have a floor until something gets above $5 a share, and maybe some other restrictions. They probably can't get to it. So it's always an interesting level to watch, because when small cap companies can get above that price level, oftentimes there's just a much bigger potential audience of people that can own their stocks. So, from a technical perspective, again, I love looking at charts like this. I know nothing about the company, so I'm no comment on what they do or what it is. This is a pure technical view based on what I'm seeing. So first off, obviously something has changed quite a bit, right? We talk a lot about what's called a change of character on the chart. And that's when the chart has a certain configuration and then something's different. Look at the trend on the first kind of 2/3 of this chart from early 23 to maybe August, September of 24. We see the stock generally below the downward sloping 200-day moving average. You see a number of attempts to regain that. In July of 23 and December of 23, both failed. You see the momentum, pretty consistently in the bearish range. And I think that's an important tell. In a bearish trend, the whole range of the RSI kind of moves downwards. You don't get much above 60 on rallies. You often get oversold on sell-offs. You can see that these new lows were often pushing the momentum down to oversold levels. Compare that to a bull phase and look at the right third of this chart. And you can see that that changed. All of a sudden, the first time we rally and become overbought, that's the first time we've been overbought in years. And so it's one of those counterintuitive things. You think overbought is bad, and that can be bad in the short term. That could tell us we're a little over our skis. Maybe we lighten up a bit. But overall, the fact that we even got up to that overbought region suggests that the momentum is actually improving quite strong. And I would say that's an encouraging sign on the chart just in the August-September timeframe. That's, of course, when we pushed above the 200-day moving average for the first time in multiple years. And then we kind of lit it up and went all the way up to 340. That was there in mid-October. Now, from there, we've settled into an incredibly painful range. And while this doesn't look like much, think about the math of going from 3.4 down to around 1.3. It's not great. You can see that here on stock charts using what's called the inspect tool. Other platforms you may use. If you look at the left part of my chart, you can see that little percentage. That's about a 62% drop, right, from peak to valley there. That's that hurts, right? I mean, that's a big move lower. And it reminds me of earlier days of Bitcoin and getting asked by reporters about Bitcoin. I'm just like, it's so volatile. It's hard to even get a read on what levels are important. So what do we do now? I would say overall, I mean, generally speaking, the fact that we're in the bullish momentum range is encouraging. The fact that we've pulled back from an overbought condition and are holding an RSI level of 40 is encouraging. The fact that we're above moving average support is all positive. I would be again, I think the thing that would concern me about a stock like this, again, knowing nothing about the company, is the fact that it's a low price name, which means expect a lot more retail activity than institutional activity, which often provides a lot less stability than you want and a lot more volatility, which is certainly what we're seeing. Be prepared for huge percent swings. So I think when you think about a name like GEVO, think about position sizing, and remember that the more volatile the name, the much smaller your position needs to be in terms of managing the risk implied by that volatility. So a smaller position, betting on improving momentum from here, I could get the argument for. So that's how I would describe this from a technical perspective. I'm more generally speaking, it's a constructive rotation that we've seen in the last 6 months. I would say for me, getting higher, getting above that previous high, improving momentum, getting above $5 is what would cause me to really get interested in a name like this. Until then, I usually avoid until proven otherwise. There we go. Random chart analysis of a stock I've not ever looked at before. What more fun could we have on a day like today? We're out of time. Folks, thanks so much for joining me here every weekday after the close. I mean, especially navigating these uncertain markets. It's been so much fun watching some of the conditions change, watching days like today, which are these big reversal days to the upside. Again, I can't stress enough that tracking these conditions and how they change day in, day out. Don't just watch the show one day. Let's do this together over time. That's when you're going to start to see the evidence change. That's when we can start to understand the story that the market is telling us over time and hopefully position ourselves effectively. For Market Misbehavior, I'm Dave Keller. Thanks so much for joining me today. And remember, it's always a good time to own good charts. Have a great night, folks.